Mr. Mark Gold, Acting President, Federal Reserve Bank of San Francisco. Ladies and gentlemen, friends and colleagues, good morning. It's great to be back here in San Francisco and to touch base again with our friends and colleagues at the San Francisco Fed and this distinguished gathering. And welcome to the Symposium on Asian Banking and Finance 2028. It was 13 years ago, in 2015, that the Federal Reserve Bank of San Francisco and the Monetary Authority of Singapore began this collaborative journey of co-organizing this symposium. So let me, on behalf of the MAS, thank Mark and his colleagues at the San Francisco Fed for the fruitful partnership and warm relationship over these many years. The symposium, as you know, began in 2007 to consider, in part, the lessons from the 1997 Asian financial crisis. Since then, we have lived through two other major crises, the global financial crisis of 2008 and the global cyber crisis of 2023. Today, I would like to take stock of the evolution of financial regulation over the last 20 years since the global financial crisis in 2008. I think three broad themes characterize this journey. First, fixing the fault lines that led to the global financial crisis. Second, managing the risks posed by fintech while harnessing its benefits. And third, defending against systemic cyber risk. Let me begin with the regulatory and supervisory responses to the global financial crisis. The advances over the last 20 years can be broken down into three distinct phases. The first 8 years following the global financial crisis, 2008 to 2016, thereabouts, saw the most wide-ranging set of reforms ever in the history of financial regulation. The destruction that the global financial crisis had unleashed on our economies and our societies galvanized action on an unprecedented scale. The global financial crisis revealed some very deep fault lines in the financial system that had been masked by fortuitous growth in the preceding years. Many financial institutions had leveraged themselves to the hilt, some of them by as much as $40 of debt to $1 of equity. Unthinkable these days. Many banks had severe mismatches in liquidity, and an opaque OTC derivatives market led to rapid contagion when liquidity suddenly dried up. Moral hazard grew as some financial institutions were seen as too big to fail. The Financial Stability Board, or FSB, was strengthened and tasked to oversee reforms to address each of these vulnerabilities. And the way the international regulatory community came together and forged a consensus on the necessary reforms was truly exemplary. So between 2008 and 2016, the FSB, working closely with the Basel Committee, IOSCO, and other standard-setting bodies, put in place the basic building blocks for a new regulatory architecture that continues to serve us today. In banking, capital buffers were increased, liquidity requirements were set, and caps placed on leverage under a new Basel III Accord. In the derivatives market, requirements were put in place for trade reporting, central clearing, and margining. And to tackle the too big to fail problem, global systemically important financial institutions, or GSIFIs, were identified and subjected to higher loss absorbency requirements, more intensive supervision, and resolution planning. Implementation of the reforms, especially the Basel III reforms, progressed well, driven by a broad consensus on preventing a repeat of the global financial crisis. The generous timelines for implementation allowed industry to adjust to the new regulatory landscape. It was only last year, in 2027, that we achieved full implementation of the final component of the Basel III reforms, the output floor. During the second phase, from 2017 to 2020, the focus turned to evaluating the effects of the regulatory reforms. There was growing feedback that some reforms had unintended consequences, some reforms were at odds with others, and that the cumulative impact of the reforms had dampened the economic growth. So a series of reviews was undertaken during this period to assess both the effectiveness and the effects of various reforms. These reviews largely affirmed that the benefits of the reforms in terms of reducing the risk of financial crisis and the consequent economic impact far outweighed the costs. In fact, controlling for other factors, there was little evidence that the reforms resulted in any general deterioration in the availability or pricing of credit. But the reviews did surface areas for improvement. They identified specific areas like trade finance, infrastructure finance, SME finance, and more generally, market liquidity risks, where the cumulative effects of various reforms had indeed led to somewhat suboptimal social outcomes. So this in turn led the way to carefully calibrated adjustments to regulations that eased the constraints in these areas without significantly increasing risk. The responsiveness and flexibility shown by regulators helped to sustain the broad-based political and industry consensus in favor of the post-crisis reforms. Today, looking back from the vantage point of 2028, we can say with greater certainty that the post-crisis reforms have left us a financial system that is on the whole more robust and more resilient. Large banks are now stronger, more liquid, less leveraged. Derivative markets are safer, better collateralized. The third phase began from around the early 2020s when the focus shifted from rule-making or regulation to enhancing the supervision of financial institutions. I'm glad Mark touched on this earlier on and gave us a very good set of definitions of the distinctions between the two. The global financial crisis was not just about gaps in regulation. It was also about gaps in risk management and supervisory oversight. Three developments in recent years added new impetus to the supervision agenda. First, as the international activities of global banks increased and became more complex, regulators realized that effective supervision increasingly required much stronger cross-border cooperation and even coordination. The Basel Concordat II of 2024 laid the foundation for more collaborative and meaningful supervisory colleges, strengthened the functions of the crisis management groups, and set out more clearly the responsibilities of home and host regulators. Second, supervision extended beyond checking on financial institutions' risk management and internal controls to better understanding the risk culture of these organizations. Processes, controls, and limits can only go so far in restraining excessive risk-taking. Ultimately, it is people that take risks. And the incentive structure, governance practices, and value system in financial institutions are what determine their attitude towards risk. Regulators came together to establish common frameworks for what we now call culture and conduct supervision. This included sharing information on errant industry professionals to deter the problem of rolling bad apples. Supervisors began to use data analytics, sentiment assessments, and the tools of behavioral psychology to gain insights on the culture and conduct of financial institutions. These insights served as inputs to supervisory assessments of the risk culture in our financial institutions and, where necessary, preemptive interventions. Third, the active integration of technology into the supervisory process, what we now call SupTech, began to dramatically enhance supervisory effectiveness by the mid-2020s. Data analytics finally solved the long-standing challenge that banks had in aggregating credit and market exposures across various businesses and geographies. This enabled banks to derive a consolidated profile almost in real time. And the integration of RegTech and SupTech allowed data from financial institutions to flow directly into regulators' databases in machine-readable formats through application programming interfaces or APIs. And supervisory officers who used to spend long hours in the old days poring over spreadsheets and reports, cutting, pasting, and computing, began to use automated surveillance dashboards. They're now able to track on a daily basis the consolidated exposures, the credit quality, the value at risk, and other indicators of the banks under their purview. They're able to carry out stress tests and simulations, not only of individual banks, but also do network analysis of risk transference across the financial system. Compared to just 10 years ago in 2018, technology has now enabled supervision to be much sharper and surveillance of systemic stability much more rigorous. The second big theme in financial regulation over the last 20 years is the rise of fintech. Now, technology has always featured in financial services. But from about 2015 onwards, there was an explosion in the application of various technologies in financial services by both regulated entities and unregulated fintech firms offering niche financial products. Fintech transformed the way financial services were produced, distributed, and consumed. It has brought significant benefits to consumers, financial institutions, and the economy at large. It has helped to reduce costs, manage risks better, create new business opportunities, and improve people's lives. But like all good things, fintech brought in its wake new risks and new challenges for regulators. The story of fintech regulation is still unfolding, but let me highlight 3 areas where good progress has been made in the last 10 years. 1, setting standards for distributed ledgers. 2, making cloud computing services safer. And 3, dealing with artificial intelligence. Experiments in applying distributed ledger technology to financial services began about 15 years ago, gathered pace from about 2018 onwards. Early days were characterized by both hype and fear. Popular imagination and regulatory concerns at the time were focused on so-called cryptocurrencies or assets. Essentially, crypto tokens, which assumed a life of their own as a means of payment or investment assets outside of the distributed ledger. But the euphoria did not last long. Crypto tokens failed to achieve scale as more people realized they did not have the properties of either currencies or assets. Today, crypto tokens are confined to very specific purposes and limited ecosystems. But after several false starts and failed use cases, the underlying distributed ledger technology, or DLT, started making significant inroads in the financial industry. Essentially, DLT made financial transactions and processes more efficient, more transparent, less risky, and less costly. The 3 areas that saw the biggest transformations were in compliance, trade finance verification, and cross-border payments. As DLT systems became more pervasive, they began to assume properties of critical infrastructure with systemic implications. There were information security-related risks, as well as operational risks associated with the interoperability across multiple platforms. While strong cryptography is a key feature of DLT systems, they are not immune to cyber attacks through the widely distributed network of participants in a distributed ledger. And old-fashioned risks, like not having enough liquidity to settle transactions, can potentially lead to gridlocks in DLT systems, which could in turn cause systemic risks. The trigger for a coordinated regulatory response to distributed ledger technology came in the cross-border payment space. In 2020, the Bank of Canada and the Monetary Authority of Singapore successfully piloted a cross-border DLT-based system that achieved almost real-time fixed income securities trading and settlement cross-border. And under the Global Payments Accord of 2024, central banks agreed to upgrade their real-time gross settlement systems to a DLT-inspired architecture with a view to connect these systems for safer, faster, and more efficient cross-border payments and settlements. This called for internationally accepted standards for DLT-based payment systems. So the FSB and standard-setting bodies worked closely with the newly formed International Organization for Distributed Ledger Standards to design a supervisory framework for DLT. DLT frameworks that performed key market functions like clearing and trade reporting were required to meet specified standards for settlement finality and the security of digital asset custody. Next, making cloud computing safer. From about 2015, financial institutions increasingly began to use the cloud. With cloud computing, financial institutions could effectively integrate customer data across platforms to enable sharper consumer insights. The cloud provided scalable storage solutions to meet the real-time demands of trading and analytics processes. Some banks have even moved their core banking systems into the cloud to reap the benefits of stability and resilience. Cloud computing has considerably enhanced risk management. Risk assessments are now more comprehensive, more granular, more real-time. But the cloud has also introduced new risks. The risks are not so much in the technology of cloud computing per se, but in the business and operating models of cloud services. Cloud services are essentially a utility provided by specialist third-party providers. And as with any third-party service providers, there are outsourcing risks associated with these cloud service providers or CSPs. But with cloud computing, these outsourcing risks are much larger, given how much of a financial institution's data and processes rely on CSPs today. Financial institutions have less knowledge, let alone control, of where their data are stored in a cloud computing infrastructure that spans several different jurisdictions. Data breach or loss might occur due to a natural disaster, a targeted attack on a CSP, or poor security processes. The outsourcing risk is compounded by concentration risk. The top 4 CSPs, or cloud service providers, in the world had a market share of 80% last year in 2027. About 25% of core banking systems of global systemically important banks, or GSIBs, is now residing on the cloud. A large supplier of cloud services can potentially become a single point of failure where many financial institutions rely on them. The regulatory response to cloud computing has taken 2 forms. First, regulators around the world have issued regulations or guidance on the management of outsourcing risks specific to cloud services. The Monetary Authority of Singapore and the UK Financial Conduct Authority were among the first regulators to do so as early as 2013. Second, the jurisdictions where these cloud service providers operate from have begun to exercise regulatory oversight over them. In the United States, the Cloud Services Utility Agency, or CSUA, was formed in 2024 with the mandate of regulating CSPs, working closely with the US Federal Reserve System. And I'm very pleased that the Federal Reserve Bank of San Francisco has been designated as the lead regulatory coordinator with the CSUA, as 2 of the 4 global dominant CSPs, I won't name them, are based in California. The use of AI in financial services. This is the third big fintech area where we've made progress. Use of AI has swept across financial services sector in recent years. Banks are benefiting from AI through better customer insights, increased productivity, and cost savings. AI applications range from customized financial services to enhanced risk management and regulatory compliance. But the growing application of AI has also introduced new risks and challenges for regulators. Foremost are concerns about market disruption and financial instability caused by runaway AI trading algorithms. The global flash crash of August 2022 demonstrated the contagion risks that multiple AI trading programs learning from one another can precipitate. When an AI trading algorithm went amok and caused the failure of US hedge fund Smart Money, AI traders across Europe, America, and Asia went into a massive risk-off mode, causing turbulence not only in the equities market, but also fixed income commodities and currency markets, in short, wreaking havoc. Herd behavior has always been a characteristic of financial markets, but herds of robots have proven to be far more deadly than herds of humans. The IOSCO, International Organization of Securities Commissions, has since mandated that exchanges have in place specific mechanisms to manage extreme volatility caused by AI algorithms. And securities regulators have started themselves to use AI to provide early warning of potentially disruptive AI-based trading patterns and trigger appropriate circuit breakers. But more generally, the increased use of AI by financial institutions has created the risk of black boxes in decision-making. Boards and senior management of financial institutions are struggling to validate AI-based models which use continuous learning and adaptation as distinct from fixed parameters and backward testing. The application of AI in financial services has also created issues of financial exclusion, which regulators cannot ignore. Regulators have begun to detect cases where AI-based decision-making has led to systemic exclusion of certain demographics. When an AI tool finds an empirical basis for discriminating by a combination of variables such as gender, ethnicity, religion, nationality, say for a loan or insurance decision, how much of that empiricism is truly grounded in reality and how much of it is due to unobserved biases in society that the AI is learning from? And even if such discrimination is backed by empirical, unbiased data, is that a socially acceptable outcome? Regulators in many jurisdictions have begun engaging the industry, as well as the broader society, on developing guidance on the responsible and ethical use of AI and data analytics by financial institutions. The third theme that stands out in the history of financial regulation over the last 2 decades is cybersecurity. But it was only after the global cyber crisis of 2023 that cyber risk management has moved to front and center of the international regulatory agenda. The global cyber crisis laid out our cyber vulnerabilities painfully. A highly skilled and well-resourced group of hackers used AI-enabled malware to infiltrate banks around the world, subvert detection, and siphon monies. Over a span of just 6 weeks, a total of $45 billion was stolen from over 500 banks, leading to a loss of public confidence and bank runs in several jurisdictions. Only 8% of the stolen funds have ever been recovered. The failure of Al Gore Bank at the height of the global cyber crisis demonstrated both the high points and low points in financial regulation. Al Gore Bank was successfully resolved with minimal disruption. Thanks to the efforts by the FSB after the global financial crisis, the major jurisdictions that Al Gore Bank operated in had robust resolution regimes. And with a clear resolution plan formulated, tested, and discussed at the bank's annual resolution college prior to the crisis, home and host regulators were able to resolve Al Gore Bank in a smooth and timely manner. But the fact that a cyber attack could bring down the 20th largest bank in the world with a Tier 1 capital adequacy ratio of 16% revealed a significant gap in the global regulatory regime for technology risk. It was ironic that in an industry where there were detailed internationally accepted standards for capital, for liquidity and leverage, and a range of prudential norms, there were no standards for cybersecurity risk management. the FSB and standard-setting bodies swung into action, and in 2025, produced a true two-track set of reforms to deal with cyber risk, which is essentially borderless. First, the FSB's cybersecurity standards, building on its cyber lexicon of 2018, established a minimum level of cyber hygiene for internationally active financial institutions. They set out harmonized standards for authentication, implementation of cryptography, intrusion detection, and incident reporting. Higher standards were set for GSIFIs. GSIFIs were required to put in place 24/7 cyber surveillance of all their internet-facing systems, undergo annual cyber vulnerability assessments by internationally certified cyber specialists, and carry out military-grade penetration tests. Second, the Basel Committee and IOSCO developed core principles and practice guides for prompt information sharing on cyber incidents and cyber threat intelligence sharing among banks and securities firms, respectively. National laws were amended where necessary to facilitate information sharing across these financial institutions without incurring legal liability. Global platforms were put in place to facilitate information sharing among central banks and regulators to counter cross-border cyber threats of the kind that triggered the global cyber crisis. And through these platforms, financial regulators are able to quickly disseminate useful cyber threat information to banks and securities firms so that they can take preemptive measures. These platforms built on the success of the earlier Central Banks, Regulators, and Supervisory Entities, or CERES platform of 2018, which enabled effective sharing of actionable cyber threat information. But the enemy has not been lying still. Hackers are now employing more advanced quantum computing technologies, and a number of weaker encryption solutions used by financial institutions have been compromised. So cybersecurity continues to be a cat and mouse game. There is no room for complacency. Let me conclude. The financial system today is more robust and resilient than it was 20 years ago. The wide-ranging regulatory reforms following the global financial crisis have stood us in good stead. There is broad consensus across industry and the regulatory community on the value of sound regulation and risk management. But the financial landscape has also transformed dramatically over the last 2 decades. The rise of fintech has changed the face of financial services. Technology has helped us to reduce some risks and better manage others. But it has also introduced new risks and vulnerabilities. The regulator's job is never done. And while we have gotten better at managing traditional risks such as credit and market risk, cyber risk has now moved to the front of the regulatory agenda. But while the landscape has evolved and the nature of threats to financial stability has changed, the core principles of sound regulation and supervision remain evergreen. The goal is to keep the financial system stable and maintain public confidence and trust in the financial sector. And to do this in a way that allows the financial sector to also innovate and grow and serve the needs of the economy and society. That means taking a proportionate approach to risk so that we can achieve resilience with efficiency, stability with growth, safety with innovation. Thank you very much. Thank you. Thought before we go into Q&A, I should read my disclaimer. Everything said about the future here is pure imagination. It is neither a forecast nor a recommendation by me or the Monetary Authority of Singapore. My intention is merely to paint a plausible scenario for the future of financial regulation as food for thought for this symposium. In all likelihood, the actual symposium of 2028 will find my account rather lacking in imagination or realism or both. The truth will always be stranger than fiction.